Welcome to Breaking News to Trading Moves. Today we're looking at the latest analysis on the China property market contraction. Our goal is to sort of translate that economic data into, well, specific market impacts. We want to identify which U.S.-listed businesses might gain from this situation and which ones are more exposed to the slowdown overseas.
Yeah, and the trigger for this conversation really is the assessment that China's property slump is frankly looking worse than people expected for this year. It's dragging out what's already been a multi-year downturn. And this matters because, property in China isn't just buildings. For most households, it's their main source of wealth. So when that feels shaky, it sends out waves. Pressure on metals demand globally, problems with domestic land sales, and it hits consumer sentiment tied to that real estate wealth.
That really sets the scene. It's a big deal when an economy that size slows down in such a key sector. But let's maybe start with the potential upside, the unexpected beneficiaries. It does seem a bit odd, doesn't it, that a contraction overseas could actually boost some U.S. stocks. But that's global finance for you.
It is, and we're seeing basically two main ways this happens. First is what we call risk off. Stress in China makes capital look for safety, and often that means U.S. dollar assets. The second mechanism is about lower input costs. Less industrial demand in China can mean cheaper materials and cheaper shipping globally.
Okay, let's unpack that risk-off idea first. Gold miners listed in the U.S. seem like a classic example. Gold's been kind of flat lately, hasn't it? Does this China housing stress really give it a new push? I mean, everyone knows gold is a safe haven.
That's fair, but yes, I think it adds another layer of support. It's almost like a double whammy for gold. First, when the property situation looks worse, you have capital inside China looking for alternatives to real estate. Some of that flows out looking for safety abroad. That feeds into general risk aversion, which helps gold prices. And second, there's the central banks. During times of global economic worries, central banks often increase their gold buying. That creates a pretty solid floor under the price.
Ah, right. So it's not just individuals buying coins. It's systemic buying from official institutions because of that global uncertainty.
Exactly. That structural support plus the risk-off flows from investors. It creates a favorable backdrop for the big gold producers. So companies like Newmont, that's ticker NEM, and Agnico Eagle Mines, ticker AEM, they stand to benefit. Their margins look better when their mining costs are stable, but the price they get for gold gets that macro lift.
Okay, that makes sense for capital flows. But moving to the second idea, lower input costs, U.S. home builders. That one seems really counterintuitive. How does a property crisis in China help someone building houses in, say, Texas?
Yeah, this is where you really see the global connections. When China's growth prospects dim, global investors tend to get more cautious. And where do they put their money for safety? Often it's U.S. government bonds, treasuries.
Right, so they buy lots of U.S. debt?
And that pushes the price of those bonds up. Basic supply and demand. When bond prices go up, their yields go down. And lower U.S. Treasury yields tend to pull down other benchmark rates, including, crucially, mortgage rates. So factor one, housing in the U.S. becomes a bit more affordable because borrowing costs might ease thanks to capital fleeing risk elsewhere. Factor two, the slowdown in Chinese industry means less demand for stuff globally. Things like steel, maybe some finished goods used in construction. That can take the edge off material costs for U.S. builders.
I see. So the builders might pay a bit less for materials, improving their margins, and U.S. buyers might get slightly better mortgage rates because global investors are piling into U.S. bonds. That's quite a combination.
Precisely. It strengthens the economics for new home sales. We'd expect this to help the big players like Lennar, ticker LEN, and DR Horton, ticker DHI. They've got the scale to really take advantage of any easing in input costs or financing conditions.
Okay. And if input costs are softening for building materials, I guess that same logic applies further down the supply chain, like for logistics and retail. Tell us about the big box and value retail importers.
Yeah, absolutely. This group benefits from the slowdown's effect on global shipping and manufacturing. When Chinese factories aren't running full tilt and construction slows, there's less demand for container ships, for freight capacity in general. We've already seen signs of port congestion easing up, and freight rates on key routes like Asia to North America have softened.
So basically, it gets cheaper to move goods around the world because the industrial engine is running a bit cooler.
That's a big part of it. Plus, think about the currency. U.S. retailers are buying goods priced in, say, Chinese yuan or other currencies, but they're earning their revenue in U.S. dollars. If the dollar is relatively strong, that gives them more buying power when they source inventory overseas. So you combine lower freight costs, maybe slightly softer prices for manufacturers who need the orders, and a strong dollar. Well, that really helps their merchandise margins.
They're essentially importing deflation in a way. That's clearly a boon for retailers who bring in a lot of goods from overseas.
Definitely. Think about Costco, wholesale ticker COST, managing those huge, complex supply chains. Or Ross Stores ticker RST, which really focuses on tight cost control in the off-price sector. These are companies where savings on shipping and sourcing can flow pretty directly to the bottom line. It sets them apart from retailers maybe more reliant on domestic production.
Okay, that covers the beneficiary side, companies gaining from risk aversion or cost savings. Let's switch gears now to the exposed companies, the ones whose business is more directly linked to Chinese construction activity and consumer wealth there, the potential losers in this scenario.
Right. This side of the equation is all about companies facing, well, direct demand destruction. When your main customer for industrial products or maybe high-end services suddenly cuts back, the impact is pretty immediate. You feel it quickly.
And it seems like copper and aluminum producers are right at the front of that line.
Absolutely. The exposure here is just massive. Construction, everything from big infrastructure projects down to the wiring and plumbing in apartments. It's the single biggest end market for industrial metals worldwide. And China consumes over half more than 50% of the world's copper.
Wow, over half the world's copper depends on China building things. That puts it in perspective.
It really does.
Hmm.
So when their property sector has prolonged weakness, it's not just a small dip in consumption. It means entire project pipelines can dry up. Developers stop ordering copper wire, aluminum window frames, you name it. This hits both the volume of metal they sell and the price they can get because suddenly there's potentially a lot more supply than demand. That flows straight through to lower revenue forecasts.
And we see that vulnerability in some major U.S.-listed miners and materials firms.
Yes, exactly. Consider a company like Freeport-McMoRan, ticker FCX. They're a huge copper producer. Or Alcoa, ticker A, heavily involved in aluminum. The prices they get for their products are very sensitive to news coming out of China about industrial activity, about construction starts. Any further bad news from the property sector there tends to put immediate downward pressure on their stocks.
And it's not just the raw materials, is it? It's also the machinery used to dig them up and build with them. Let's talk about heavy equipment and construction machinery.
Yeah, this is maybe a slightly delayed effect compared to metals, but just as significant. The key issue here is developer financing getting squeezed. Chinese banks, local governments, they're under stress. So developers find it much harder to get loans to start new projects, or even sometimes to finish existing ones at the planned pace. What does that mean? It means their need to buy new bulldozers, excavators, cranes. It just drops dramatically.
So fewer building projects mean fewer orders for companies like Caterpillar, even before you think out the market for used equipment.
Precisely. And the slowdown hits multiple revenue streams. It hits the sale of big, expensive new machines first. That's the obvious hit. But over time, it also cuts into demand for spare parts, for maintenance services, for equipment rentals. If the machines aren't working, they don't need parts or service. This exposure is quite clear for global players like Caterpillar ticker CAT and Terex ticker TEX. Both have significant sales exposure to the Asia-Pacific region.
Okay, finally, let's connect this back to consumption, especially the higher-end spending tied to that wealth effect you mentioned earlier. Let's look at the Macau and China-exposed casinos.
Right, this is probably the clearest example of the negative wealth effect in action. The slump in property values makes Chinese households feel less wealthy. Even the affluent ones, the typical visitors to Macau's VIP rooms and premium mass market tables, they feel less secure when their main asset, property, is potentially falling in value.
So they might not be going broke necessarily, but they might just tighten their belts a bit, especially on things like luxury travel and gambling trips.
Exactly that. Macau depends overwhelmingly on visitors from mainland China. When that sense of wealth diminishes, people cut back on big discretionary spends. Gambling trips are definitely in that category. We tend to see this impact travel data, especially around big holidays. The result is a direct hit to gaming revenues in Macau. You can see it pretty clearly in the visitor numbers and spending figures when they come out.
And this vulnerability is particularly concentrated in the U.S.-listed casino operators with a major Macau footprint, right?
Yes, definitely. Think about Wynn Resorts, ticker WYNN, and Las Vegas Sands, ticker LVS. Even though they try to diversify with shopping and shows, their core earnings are still heavily tied to gaming volume from mainland Chinese visitors. A drop in spending or visits from that group hits them hard. They really act as a sort of proxy for high-end Chinese consumer confidence.
So bringing it all together, this analysis really shows how a property issue in one major economy can create these diverging paths globally. On one hand, you have capital seeking safety or benefiting from lower costs, helping gold miners, some retailers, maybe home builders.
Uh-huh. And on the other hand, you see that direct hit to demand for industrial goods and high-end discretionary spending. That puts immediate pressure on metals companies, machinery makers, and those casinos heavily exposed to Chinese consumers. It really underlines how interconnected everything is in the global financial system.
Okay, before we finish up, just a reminder for everyone listening, this is not financial advice. It's not a recommendation to buy or sell any security. This is purely the opinion of the author.
Absolutely. And maybe just a final thought for you to chew on. If this softer trend in China's property market continues, how might that influence global inflation beyond just those materials costs we talked about?
Yeah.
Could that persistent weakness eventually feed into things like labor costs or manufacturing capacity pricing, even outside the commodity space? Something to consider.
That's a great question to ponder. Thank you for joining us on Breaking News to Trading Moves.